$17 billion. That number vanished in a single evening, not over months of decline, not through years of bad trades. In one coordinated act, on one Sunday night, the Swiss government erased $17 billion in investor money, while shareholders walked away with $3 billion in UBS stock. The bondholders, the people who lent money with a contractual expectation, reinforced by every other regulator on Earth, that shareholders would absorb losses first, got nothing. 3,000 investors across Asia, the Middle East, and Europe watched their holdings go to zero. And here is what makes this different from every banking collapse you have heard of. In a partial ruling now under appeal, a court has found it was unlawful, not a technicality, not a procedural error. The Swiss Federal Administrative Court examined this for 2.5 years and concluded that no valid legal basis existed for what happened. The government rewrote the rules on a Sunday, and the court said they had no right to do it. This is the story of Credit Suisse. Not the version about reckless bankers or greedy traders. Every channel has told you that. This is the forensic version. How a 167-year-old institution built a machine that paid $31 billion in bonuses while losing $33 billion, and how the architecture of that machine determined who got paid and who got destroyed on the night it finally collapsed. The fracture pattern starts in 1856. Alfred Escher was arguably the most powerful civilian in Swiss history, a 4-time president of the National Council, founder of ETH Zurich, and builder of the Gotthard Tunnel. When Escher launched Schweizerische Kreditanstalt, the bank that would become Credit Suisse, he offered 3 million Swiss francs in shares. Within 3 days, investors subscribed 221 million. It was oversubscribed 73 times. The country did not just want this bank, it needed it. Switzerland was industrializing, and Escher built the financial engine to fund it. For more than a century, that engine worked. Credit Suisse sat at the center of Swiss economic life, conservative, methodical, trusted. But the expansion that would eventually destroy it followed the same pattern every time. Expansion beyond the Swiss core into riskier territory, preserving the reward structure for insiders while shifting the consequences to everyone else. The first visible crack appeared in 1977. A branch manager named Ernst Kurmeier had been routing client money through a Liechtenstein shell company called Tetzen Finanzanstalt. 2 billion Swiss francs moved through this pipeline. When Tetzen collapsed, Credit Suisse absorbed a 1.4 billion Swiss francs loss. The bank survived. But notice the architecture. An insider exploited the system. The institution absorbed the damage, and the expansion into shadowy offshore structures continued. Fast forward to the 2000s. Credit Suisse had transformed into a global investment bank, competing directly with Goldman Sachs and JP Morgan. The reward structure scaled dramatically. Between 2010 and 2022, according to Switzerland's own parliamentary investigation, Credit Suisse lost 33.7 billion Swiss francs. During those same 12 years, it paid out 31.7 billion in bonuses. The losses and the bonuses were almost identical. The machine was consuming itself, but the people operating it were still getting paid. That pattern is the fracture, not greed in the abstract. A specific, measurable architectural flaw, the bonus pool operated independently of the loss ledger. Every expansion into risk, Mozambique debt, Archegos swaps, Greensill supply chain funds, generated fees that funded bonuses before the losses materialized. By the time the losses arrived, the bonuses had already been distributed. The people who created the risk had already been rewarded. In 2014, Credit Suisse pleaded guilty to helping Americans evade taxes. The fine was $2.6 billion. The bank survived. In 2019, Credit Suisse hired private investigators to surveil a departing executive named Iqbal Khan. One of the investigators died during a confrontation in September. The chief operating officer resigned. The chief executive officer was forced out 4 months later. The bank survived. In 2021, 2 disasters hit within weeks. Greensill Capital collapsed in March, exposing Credit Suisse to approximately $3 billion in losses through supply chain finance funds the bank had marketed directly to its own wealth management clients. $10 billion in investor money had been channeled through these funds. Then, days later, Archegos Capital Management, a family office run by Bill Huang, blew up on leveraged total return swaps with notional exposure exceeding $20 billion. Credit Suisse lost $5.5 billion on these positions. Goldman Sachs and Morgan Stanley had exited their Archegos exposure within the first 48 hours. Credit Suisse was the slowest to act. Its prime brokerage infrastructure was so degraded that internal risk teams later described a system built on spreadsheets stitched together with VBA macros and a pricing server that crashed twice a month. 2 multi-billion-dollar failures in the same quarter from 2 completely different business lines, both were enabled by the same root cause: risk oversight subordinated to revenue generation. In February 2022, the Swiss Secrets Investigation published leaked data on 18,000 accounts linked to 30,000 clients, with assets exceeding $100 billion at peak. Dictators, arms dealers, sanctioned individuals, all banked by the institution Alfred Escher built to fund Swiss railways. Each scandal followed the fracture pattern: expansion into risk, rewards distributed before consequences arrived, institutional survival at any cost, until the cost became unsurvivable. By the fourth quarter of 2022, clients were pulling their money, not gradually. 111 billion Swiss francs left Credit Suisse in 3 months. The bank secured emergency facilities. Management insisted the liquidity position was sound. But the architecture was already failing, and the kill shot came not from a regulator, not from a trading loss, but from 5 words spoken on live television. March 14, 2023. Credit Suisse delayed its annual report and disclosed material weaknesses in internal financial controls, flagged by its auditor, PwC. Shares fell 5%. The market was already nervous. Silicon Valley Bank had collapsed 4 days earlier. Signature Bank failed 2 days after that. American regional banks were failing, and the contagion was spreading to any institution perceived as fragile. March 15, Riyadh. A Bloomberg journalist asked Ammar al-Qudairy, chairman of Saudi National Bank, whether his institution would provide additional financial support to Credit Suisse. Saudi National Bank held a 9.9% stake, the largest single shareholder. He replied in 5 words: "The answer is absolutely no." The reasoning was technical. Crossing 10% ownership would trigger additional regulatory requirements from 3 separate jurisdictions: Saudi, Swiss, and European. Al-Qudairy was stating a regulatory fact. But markets do not process regulatory nuance at speed. They heard the largest shareholder say no. Credit Suisse shares crashed 24% that day. It was the largest single-day decline in the bank's 167-year history. European bank stocks lost $60 billion in a single session. The Swiss National Bank announced a 50 billion franc emergency credit line that evening. The next day, shares rebounded 40% after Al-Qudairy attempted a walkback on CNBC. But credit default swaps on Credit Suisse debt hit 3,468 basis points, pricing in near certain default. By March 17th, the Wall Street Journal reported outflows of approximately $10 billion per day. BlackRock, which had been exploring a rival acquisition, dropped out. A Middle Eastern consortium offered $5 billion in fresh capital. Swiss authorities rejected it. The decision had already been made. Over the weekend of March 18th to 19th, negotiations took place in Bern. UBS, Switzerland's other global bank, was the only viable buyer. The question was not whether Credit Suisse would be absorbed. The question was, who would bear the losses? On Sunday evening, March 19th, the deal was announced. UBS would acquire Credit Suisse for 3 billion Swiss francs in stock, roughly 4% of book value, and a 60% discount to Friday's already cratered closing price. Shareholders received 76 centimes per share. At its 2007 peak, Credit Suisse had traded at 96 francs. The decline from peak to buyout was 99.2%. But here is where the architecture of this collapse becomes unlike any other. To understand what happened next, you need to understand a financial instrument called an AT1 bond. Imagine lending your neighbor $100,000 secured by his house. He goes bankrupt. The court says you get paid before his family divides what is left. But the government steps in on a Sunday night and says actually, the family keeps $3 billion and you get nothing. That is what happened to 3,000 investors on March 19, 2023. AT1 bonds, called Additional Tier 1 and sometimes called COCO bonds, were created after 2008 under Basel III rules. They are perpetual hybrid instruments designed to absorb losses if a bank approaches failure. The contracts contain two triggers. The first is a contingency event, activated if core capital falls below 7%. The second is a viability event, which has two subtypes. Type A requires the regulator to notify the bank. Type B requires an irrevocable commitment of public sector support. FINMA, the Swiss financial regulator, invoked a viability event Type B. At approximately 8 o'clock in the evening of March 19, 2023, the Federal Council inserted a new provision, Article 5A, into an emergency ordinance. That single article authorized the complete write-down of all 13 outstanding AT1 instruments. 16.5 billion Swiss francs, approximately $17 billion, went to zero. The standard hierarchy in virtually every resolution framework on Earth places bondholders above shareholders. AT1 bonds sit lower than senior debt, but they sit above equity. Regulators in London, Frankfurt, and Hong Kong all confirmed this within days of the Credit Suisse deal. Switzerland decided otherwise. If you have found this level of detail valuable, subscribing helps this channel dig deeper into the mechanisms behind stories like this. The global AT1 market, approximately $250 billion, convulsed. The ICE-B of a COCO index dropped 14.3%. Spreads exploded from 400 to over 1,000 basis points. Within 24 hours, the European Central Bank, the Bank of England, the Hong Kong Monetary Authority, the Monetary Authority of Singapore, and Canada's OSFI all issued statements explicitly distancing themselves from the Swiss approach. Every major regulator said the same thing. In our jurisdiction, shareholders absorb losses before bondholders. The message was clear. What Switzerland did was an exception, not a precedent. Some argue the bondholders knew exactly what they were buying. AT1 instruments pay 7 to 10% coupons precisely because they carry this risk. The prospectuses contained explicit language allowing FINMA to write them down before equity. Others counter with a simpler point. Shareholders are meant to get wiped out before bondholders. That is how seniority risk works. It is the foundation of every capital structure in every jurisdiction on Earth, until it wasn't. The Federal Council had invoked Articles 184 and 185 of the Swiss Constitution, emergency powers designed for existential threats to national security and public order. These provisions had historically been reserved for wartime or natural disasters, not corporate restructurings. The emergency ordinance, published as AS 2023-135, contained two extraordinary provisions. Article 10, A, bypassed the Merger Act's requirement for shareholder approval, meaning UBS could absorb Credit Suisse without a single shareholder vote on either side. Article 5, A, authorized the complete AT1 write-down. Both provisions were drafted and enacted within hours, during a weekend, behind closed doors. When investors later discovered the timeline, that the legal authority for the write-down had only been created at 8 o'clock on the same Sunday evening it was used, one Swiss financial commentator called it a little bit banana republic. The finance delegation, a small parliamentary subcommittee, approved 109 billion francs in emergency credit facilities on the same evening. On April 11 and 12, an extraordinary session of the full parliament convened. The National Council voted twice against the guarantee package, a rare alliance of the left and the right with Social Democrats, Greens, and the Swiss People's Party united in opposition. The Council of States voted in favor. Every vote was purely symbolic. The contracts had been signed, the money had moved, the bank had been absorbed. A GFS Bern poll found 54% of Swiss citizens opposed the rescue. 40% preferred temporary nationalization. 12 days after his Bloomberg interview, Ammar al-Qudayri resigned as chairman of Saudi National Bank, citing personal reasons. The Saudi investment, made 4 months earlier at 3 francs 82 per share, had lost approximately $1.17 billion. Roughly 80% of the original commitment was destroyed in less than half a year. In December 2024, Switzerland published the results of its parliamentary investigation, only the 5th such investigation in the country's history. That this report exists at all is remarkable. When the investigation was first announced, the committee imposed a 50-year secrecy period on its files. 50 years, long enough for every decision-maker involved to be dead before the public learned what happened. The backlash was immediate. Swiss citizens demanded transparency, and the investigation committee ultimately published its findings, a 569-page report, unanimously adopted, built on 79 hearings with 62 individuals, and analysis of 30,000 pages of documents. The findings confirmed the fracture pattern at its most precise: 33.7 billion in losses, 31.7 billion in bonuses. It revealed that FINMA had granted Credit Suisse a regulatory filter in 2017 that artificially inflated the bank's capital ratios by 15.3 billion francs. Without that filter, Credit Suisse would have failed capital adequacy requirements by 2021, 2 years before the actual collapse. The investigation delivered its sharpest criticism to former finance minister Ueli Maurer. He refused written briefings on Credit Suisse, citing fear of leaks. He publicly described the bank as stable in December 2022, while internally aware of the accelerating outflows. He failed to brief his successor, Karen Keller-Sutter, who inherited the crisis weeks into her new role. Then, on October 1, 2025, the Swiss Federal Administrative Court in St. Gallen issued its ruling in Case B-2334, 2023. It was a 77-page partial decision covering approximately 360 proceedings filed by roughly 3,000 bondholders. The court found the AT1 write-down unlawful, not on a technicality, on 3 fundamental pillars. First, no contractual viability event had actually occurred. Credit Suisse was still adequately capitalized at the moment of write-down. Second, no valid statutory basis existed in the Banking Act, the Financial Market Supervisory Act, or the Emergency Ordinance itself. Third, Article 5A was unconstitutional, too vague, and in violation of property rights protected under Article 26 of the Swiss Constitution. No compensation has been paid. FINMA appealed to the Federal Supreme Court the next day, and UBS joined the appeal. Legal scholars estimate final resolution could take 5 to 6 years. The Oxford Law Blog, in a January 2026 analysis, criticized the ruling as overly formalistic, arguing the court failed to adequately weigh the systemic emergency that justified the intervention. AT1 claims, which had been trading at roughly 12 cents on the dollar, jumped to between 22 and 35 cents after the ruling. Quinn Emanuel represents more than 1,000 bondholders holding over a third of the total outstanding AT1 debt. The legal battle will likely define a global precedent for how hybrid instruments are treated in future banking crises. Credit Suisse ceased to exist as a standalone entity on May 31, 2024. UBS now holds combined assets of approximately $1.54 trillion against Swiss GDP of roughly $820 billion. One bank, nearly twice the national economy. 35% of Swiss domestic deposits, 31% of corporate loans, 26% of mortgages. Switzerland had two banks that were too big to fail. One of them failed. The solution was to merge them into one bank that is too big to even comprehend failing. The Swiss government proposed from $24 to $26 billion in additional capital requirements for UBS in June 2025. The legislation is not expected before 2028. The parliamentary investigation made 20 recommendations, including giving FINMA the power to levy fines, a power it did not have during the entire Credit Suisse era. It also recommended banning bonuses at systemically important banks that fail to generate profits. The same recommendation, had it existed 20 years ago, would have severed the fracture pattern before it could consume the institution. Alfred Escher built Credit Suisse to fund a nation's future. 167 years later, the architecture he created had been hollowed from within. Every crisis followed the same blueprint: expand into risk, distribute rewards before consequences arrive, and when the structure finally fails, let someone else absorb the damage. The bondholders absorbed it in 2023. A court said that was unlawful in 2025. And the people of Switzerland absorbed the rest, a single bank now holding their deposits, their mortgages, and their economy in one balance sheet with no domestic alternative. Whether the court's ruling holds on appeal will determine something larger than $17 billion. It will determine whether governments can rewrite financial contracts during emergencies, or whether the rules that existed before the crisis are the rules that apply during it. Credit Suisse was not killed by 5 words on television. It was killed by an architecture that spent $31 billion rewarding the people who created $33 billion in losses. The 5 words just told the market what the architecture had already guaranteed. If this is the first video of ours you have watched, the channel explores how power structures like this are built, how they operate, and how they collapse. There's more to come.